But now I think just like we went off the gold standard in 1971, the world is going off the dollar standard, and it is going back on a gold standard. And now what's also significant is Wall Street has finally woken up, and, prices, I think, are just going to head ballistic from here. Silver just hit a new all-time record high. It's above $51. We finally took out the peak from 1980. I think we're going to be at 100 pretty quickly. We could even be at 100 next year. And I think gold, which is now above 4,000, has a shot at 5,000 by the end of the year. But it may not get that high this year, maybe 4,500. But I think 5,000 is definitely in the cards for 2026. In fact, we could be at 6,000 or higher next year in gold.
The world's biggest debtor lecturing others about fiscal discipline. Peter Schiff says that's exactly what's happening with the United States. During Trump's presidency, Washington talked tough about responsibility and strength but spent recklessly, piling trillions more onto an already unsustainable national debt. Tariffs strained relationships with key trading partners, while Trump's open attacks on the Federal Reserve's independence rattled global confidence in the dollar system. What this created, Schiff argues, is the beginning of the end for the dollar's dominance. He points to China as the quiet architect of what comes next. For decades, China's massive dollar reserves symbolized economic strength. Now, Schiff says they look more like a liability. Beijing has been steadily reducing its U.S. Treasury holdings, ramping up gold purchases, and keeping nearly all of its domestically mined gold within its borders. He believes the next logical step could be breaking the Hong Kong dollar's peg to the US dollar and eventually linking China's currency to a gold-backed system. When it comes to Bitcoin, Schiff draws a clear line. He doesn't see it as a rival to gold or a safe haven. Instead, he says Bitcoin still moves in lockstep with the Nasdaq and other risk assets. If tech stocks correct, Bitcoin likely drops too. Gold, on the other hand, behaves differently. It tends to thrive when fear hits the markets. That's why Schiff believes that if the next sell-off comes, it won't be Bitcoin leading the charge, it'll be gold stepping back into the spotlight, just as it always does when confidence in paper wealth starts to crack. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Well, I think what you're seeing is the acceleration of de-dollarization that began really a couple of years ago. I think what started it in earnest was the Biden sanctions against Russia, which really was a wake-up call for the rest of the world that they need to get rid of dollars. They need to have a more secure reserve that can't be just confiscated at the whim of the United States. And then I think it accelerated with the election of Donald Trump and the complete reckless and irresponsible spending by the Trump administration, despite the fact that Trump campaigned to try to do something about the reckless Biden spending. He made it worse. The big, beautiful bill just expanded on the excess spending and made it clear that we're never going to get our house in order. Then on top of that, Trump imposed the tariffs and vilified a lot of our trading partners for basically participating in the dollar's reserve currency status. And he's beating up the Fed about how stupid and what a moron Powell is, and we've got to slash interest rates, and he's trying to fire the FOMC members that he disagrees with so he can put his own cronies up there. So really throwing into question the independence of the Fed. And so we've basically told all the foreign central banks, get out of dollars, get out of treasuries. You're going to get wiped out to dollar debasement, that inflation. And where are they going to go? There's only one alternative, one viable alternative to the dollar, and that's gold. They're not going to, move into euros or pounds or Japanese yen or RMB. Gold is the one monetary asset that all these central banks can rely on. It is the system that dominated pre-Bretton Woods, and even in the initial years of Bretton Woods, up until 1971, even though the world was using the dollar was redeemable in gold. So the world was still backing its currency with gold, even though they did it through the US dollar. But now I think just like we went off the gold standard in 1971, the world is going off the dollar standard, and it is going back on a gold standard. And now what's also significant is Wall Street has finally woken up to this reality. And now you're seeing major Wall Street banks that have never recommended gold now saying that their clients need to have exposure to gold, whether it's 10%, 20%. It's now something that, mainstream investors are finally going to start to participate in. And, prices, I think, are just going to head ballistic from here. Silver just hit a new all-time record high. It's above $51. We finally took out the peak from 1980. I think we're going to be at 100 pretty quickly. We could even be at 100 next year. And I think gold, which is now above 4,000, has a shot at 5,000 by the end of the year. But it may not get that high this year, maybe 4,500. But I think 5,000 is definitely in the cards for 2026. In fact, we could be at 6,000 or higher next year in gold. Yeah, well, first of all, we've made it clear that China is our enemy, right? And so China recognizes that, despite the fact that they're our biggest supplier of goods and one of our biggest lenders, right? So talk about biting the hand that feeds you. We have owed a lot to China, and we've basically framed them as our enemy. And so why would our enemy want to hold its reserves in US dollars and US treasuries where they're extremely vulnerable? So I think China is completely divesting. It's on that path of replacing its dollar reserves with gold reserves so it can truly have an independent monetary system. I think eventually they're going to depeg the Hong Kong dollar from the US dollar and maybe peg it to an RMB that I think ultimately will be backed by gold. I think the Chinese are headed for a Chinese currency that is backed by and maybe even convertible into gold, just the way the US dollar was at once upon a time. I think that is the direction that they're going. And China is the world's biggest gold producer, so they have a lot of gold in China that they're producing. They just don't export any of it because the Chinese government buys it as fast as they could dig it out of the ground. Well, the reason that Bitcoin is up that much is because there was a big drop in Bitcoin, and then it had a huge rally, right? But if you look at the peak from Bitcoin, which was in 2021, when they had right after the ETFs came out and all that, or there was, Bitcoin got up to 69,000 in November 2021. And at that time, gold was around 1,900. Today, Bitcoin's around 123,000 and gold is over 4,000. Bitcoin is about 15% lower today than it was at that peak priced in gold. And so to me, that was peak Bitcoin. Even though technically in August of this year, Bitcoin got a little bit higher than that in terms of gold, but not much, but has since collapsed. I mean, Bitcoin then declined by a full 20% priced in gold.
All right. So
maybe it's down about 18% right now from its peak from August. I think there's a lot of downside risk in Bitcoin. I mean, I think Bitcoin is much more highly correlated with the NASDAQ. And tech stocks, the NASDAQ made a new record high yesterday as well. So risk assets have been in favor, and there's been a big appetite for risk. But we can easily have a correction or a bear market in risk assets, and that would include Bitcoin. And I think if investors get more risk adverse, they're more likely to want to buy more gold, not less. So if we have an overall decline in the stock market, the gold bull market can continue.
Major investment firms are finally admitting it belongs in a portfolio, something Schiff has been saying for decades. That shift isn't just validation. It signals the start of a powerful demand wave. Central banks are still buying gold aggressively, and now they'll be competing with institutional and retail investors who are waking up to the same reality. The U.S. is cutting rates while inflation rises, and Schiff believes the Fed will return to quantitative easing soon to control long-term rates as global demand for treasuries falls. If investors follow Morgan Stanley's new advice to shift from a 60-40 stock bond portfolio to 60/20/20 with gold, that will mean massive bond selling and even more upward pressure on gold prices. In his view, inflation is spiraling far beyond the official CPI numbers, which he calls deliberately misleading. The government, he says, underreports inflation to hide the consequences of its own policies. Real inflation, he argues, is closer to double the official figure because what truly drives it is money and credit creation. As the money supply expands, the dollar weakens, and people naturally move into assets that hold value, gold being the most reliable. Let's get back to the interview.
Yeah, I mean, the reason I put that clip from 10 years ago up on my X account, and that was when gold was at 1,200, right? But that was typical of the way I was treated on like a CNBC when I recommended gold. Everybody laughed at it. They said it was a stupid investment. They said that the only reason I'm recommending gold is because I'm a gold salesman and I'm just trying to get people to buy gold. And of course, they never said that to stockbrokers, of course, which I also was. But you have all these investment advisors and stockbrokers recommending stocks, and they never question their objectivity. They don't question the objectivity of the Bitcoin community. Somebody comes on like a Michael Saylor and says, buy Bitcoin. No one says, well, come on, Michael, you're only saying that because you're leveraged and loaded up with Bitcoin. No, it was only me who recommended gold that they just accused me of just talking my book and being disingenuous and trying to scare people into this lousy investment. And the bottom line is it was a good investment. Most people have done better in gold than in the stock market over 10 years, 25 years. And they're certainly doing a lot better in gold this year by a long shot. You know, they keep talking about the record highs in the stock market. This is one of the worst years ever for the U.S. stock market if you price it in gold. So gold investors are doing a lot better. But my point is that now, finally, people are not getting laughed at for recommending gold. Right now you have, okay, yes, maybe we should have gold in a portfolio. Yes, right? They should have had it in their portfolio 25 years ago, right? But the fact that they're now starting to include it, not only does that, basically validate what I've been saying all along, but it means that the demand for gold is about to go through the roof. Because central banks are going to keep buying. They have a lot more gold to buy than they've already bought. But now they're going to be competing with private investors, both institutional and retail, in this market. And, I have this gold company called Schiff Gold, and sales for the last 3 years have been very lackluster. I mean, it's not like gold has been going way up. It's doubled, more than doubled in the last 2 years. Yet business has been slow because people were afraid that gold's topped out. I don't want to buy the highs. So a lot of the normal buyers have been on hold. Now everybody is starting to realize that the sky's the limit on gold, that there is no top because there's no floor to the dollar. That's really what's happening. The dollar is going to be losing a lot of value as we open up the spigots. The Fed is cutting interest rates into rising inflation. Not only is inflation well above the 2% target, but it's headed in the opposite direction. It's going up. Yet the Fed is cutting rates anyway. I think by next year, they'll be back at QE because they're going to try to keep long-term interest rates from rising, which is what they're going to do. We're going to see a backup in interest rates as the world sells treasuries to buy gold. In fact, you mentioned, Morgan Stanley said the 60-40 portfolio should be 60-20-20, where you cut the bond allocation in half. So if all these Morgan Stanley clients sell half their bonds, which would be a lot of U.S. treasuries to buy gold, not only does that push gold up, but that pushes treasury bonds down and pushes yields higher. And the Fed doesn't want higher yields. Trump doesn't want them. So the only way to bring them down is massive quantitative easing, which is just going to drive even more demand for gold because all that is more inflation and more reasons to get rid of your dollars. Well, people are recognizing the path that we're on. I mean, the idea that the Fed is going to maintain 2% inflation is now a complete fiction. Nobody believes that anymore. I don't even think the Fed believes it. And I don't even know that they have a target anymore. In fact, the only reason they had a 2% target was because we were below 2% for a while. And so they invented that target as an excuse to create inflation. But now that we're well above 2% and they still want to create inflation, there is no target. But people are appreciating that fact, and they're starting to get out of dollars and into other assets, whether it's, gold, stocks, or, crypto. I mean, I think the people that are choosing Bitcoin are making a mistake, but they're choosing it for that reason. They think they're getting out of the dollar into something better. And the CPI, right? When you're looking about inflation, the CPI is a very flawed measure of the effects of inflation. And that is by design. It's not a coincidence that the government designed a methodology for tracking inflation that understates how much inflation there is. Because the government creates inflation on purpose. Inflation is a tool that the government uses because it solves a lot of their problems. Of course, it creates problems for the people, but governments love inflation. But since the people don't, government wants to create inflation, but not let anybody know how bad it is. And so, that's why they shouldn't be the ones that track consumer prices, but they do. So the CPI doesn't really capture what's going on. So if you look at the CPI and, prices are going up 3%, that's not even close to reality. You have to at least double it, if not more, to get a more realistic, assessment of how much prices are going up. But what really is inflation is not prices rising. That's an effect of inflation. Inflation is an expansion of the money supply, which includes credit. So as we get more money and more credit into the economy, that's inflation. And we have massive, not only monetary growth, but credit growth. And that's what's fueling the debasement of the US dollar, which is why prices go up. And it's why people now want to get out. They want to get out of their US dollars and into something that will retain its value. Yeah, the Fed is using weakness in the labor market as an excuse to cut rates, as if rate cuts are going to strengthen the labor market. They won't. I mean, the labor market is not weak because interest rates are too high. I mean, interest rates are too low. I mean, that is one of the problems in our economy. The reason we don't have enough domestic savings, the reason we don't have enough manufacturing is because we've had interest rates too low. We've had excess consumer spending, excess borrowing that has, inhibited real economic growth. So what these rate cuts are going to do is just strengthen inflation, not the labor market. And I think the rate cuts are actually going to weaken the labor market because higher inflation is going to, dampen real consumer spending, and it's going to lead to more layoffs. So what the Fed is doing is not going to work. Now, the other thing they're trying to do is prop up the housing market because home prices are too high and they need to come down. But rather than letting real estate prices fall, which is the obvious solution to the affordability problem, the Fed wants to drive mortgage rates down so that people can borrow more money to overpay for homes. That's not going to work either because mortgage rates aren't going to come down. I mean, the only rates that may come down would be the short-term rates. So you may start to see more people taking a risky adjustable rate mortgage in order to get a payment that they can actually swing. But we've seen that movie before, and we know how it ends.
What's unfolding now feels less like a temporary market cycle and more like a slow realignment of global trust. The pillars that once supported dollar supremacy, faith in U.S. debt, central bank cooperation, and consistent policy, are eroding in plain sight. Gold, once dismissed as a relic, is quietly regaining its role as the anchor of confidence while the financial world braces for the consequences of too much printed money chasing too few real assets. The shift isn't just economic, it's psychological. Nations and investors alike are realizing that stability built on debt has an expiration date. And when that realization spreads far enough, the move back toward tangible value could accelerate faster than anyone expects. Will this transition mark the long-anticipated handover from paper promises to real assets, or will policymakers find a way to delay the reckoning yet again? So stay tuned. If you're into real, data-backed takes on the financial system, Hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.